Welcome. We are here to report the core income tax planning strategies. And the first topic is the classification of taxpayers. So we all know what taxpayers since it was discussed from the first reporter, and also this was discussed from our income tax subject. So basically the taxpayers are the people who owns business or corporation which generates higher income. In other words, a taxpayer is someone who is required by the law to file and pay their taxes as imposed and prescribed by the NIRC or the National Internal Revenue Code. So a taxpayer may be an individual, a corporate, or other corporate taxpayers. So for further discussion about the taxpayers, let us proceed to classification of taxpayers. So first, the individual taxpayers. So the first individual taxpayer is the resident citizen. A resident citizen is a Filipino citizen who is residing in the Philippines. So the tax treatment are tax on income-derived sources within or without the Philippines. So meaning all income earned are taxable whether earned locally or abroad. So for example, a Filipino living in Manila. So naa siya salary from the Philippines but also naapod siya income in a foreign freelance and foreign client. So in that situation, that two income earned sa Philippines o sa abroad, it is taxable in the Philippines. So next is the non-resident citizen. A non-resident citizen is a citizen or a Filipino citizen who established physical presence abroad with the intention to reside there or dito na sila buyo or leaves the Philippines as an immigrant or for permanent employment abroad or stays outside the Philippines for more than 183 days during the taxable year. So the tax treatment for non-resident citizen are taxed only income derived within the Philippines. So, manay lang gitawag na status of taxation. So, meaning, income earned abroad is not taxable here in the Philippines. So, kibali, ang taxable ra is katuhang imong na-earn diri sa Pilipinas. So, let's say, for example, OFW in Dubai. So, naa siya yung rental business diri here in the Philippines. Then, katong rental income, mao na to ang taxable here in the Philippines. While ang iyang salary dito sa Dubai is not taxable. So, reciprocity. So, next is the resident alien. A resident alien is a foreign individual who has acquired residency in the Philippines. So, as a general rule, foreigners are considered residents if their stay or assignment is indefinite or exceeds 2 years based on DIR rulings. So the tax treatment for that is resident alien are taxed only on income derived within the Philippines. So same as as a non-resident citizen. So for example, a Japanese national living and working in the Philippines. So the income earned within the Philippines is taxable, but the income from business in Japan is not taxable. So next is the non-resident alien engaged in trade or business. So a non-resident alien engaged in trade or business is a foreign individual who has not acquired residency but is doing in the Philippines or stays in the Philippines for more than 180 days in any calendar year. So for the tax treatment, they are taxed only on income derived within the Philippines, similar to resident aliens and non-resident citizens. So let's say for example, a foreign consultant staying in the Philippines for 8 months. So katong na-earn niya nga income from the Philippines or from the Philippine clients, mauto ang taxable ra dito sa Pilipinas. So next is the non-resident alien not engaged in trade or business. So a non-resident alien not engaged in trade or business is a foreign individual who stays in the Philippines for more than 180 days during a calendar year. So for the tax treatment of that is taxed only on income derived within the Philippines. So same kasi as a non-resident citizen, resident alien, o non-resident alien engaged in trade or business. But then, it is subject to a final withholding tax of 25% based on gross income, not on net income. So no deductions allowed dire sa not engaged in trade or business. So for example, a foreign artist who performed in the Philippines for 1 month. So katong professional fee nga na-earn niya, mo to'y taxed at 25% gross. So let us proceed to corporate income taxpayers. So corporations are taxed differently from individuals and are classified as domestic or foreign. So first of the corporate income taxpayers is the domestic corporation. So a domestic corporation is a corporation organized under Philippine laws. This includes the OPC or the one person corporations owned and registered by resident citizens. So sa domestic corporation, ang iyang tax treatment is taxable siya, the income derived is taxable siya within or without the Philippines. So the next is the foreign corporation. A foreign corporation is a corporation and organized under sa foreign laws. So basically, ang foreign corporation has two types, the resident and the non-resident foreign corporation. So a resident foreign corporation is a foreign corporation engaged in trade or business in the Philippines. So nag-operate sila through a branch, office, or a permanent establishment. Ang ihang tax treatment is tax ra sila or the income earned or income derived is taxable within the Philippines. Let's say for example, a Samsung Electronic Philippines Corporation. So Samsung is incorporated in South Korea. It operates a branch office in the Philippines. So kibali na sila branch diri sa Pilipinas. So the Philippine branch sell products, manages operations, and earns income here. So in that situation, why is it is a resident foreign corporation? So foreign corporation siya kay the Samsung is incorporated in Korea. So kibali, that foreign corporation is doing business here in the Philippines through a branch. So next is the non-resident foreign corporation. Foreign corporation not engaged in trade or business in the Philippines. So for the tax treatment, it is only taxed on Philippine source income, usually kanang through FWT or final withholding taxes. So for the last is the other corporate taxpayers. So this includes the OPC, the one-person corporation, and the partnerships, which has 8 types. So the first is the one-person corporation. So this corporation, or this is a corporation with a single stockholder. The stockholder may be a natural person, a trust, an estate, or even if there is only one owner, it is still treated as a separate legal entity for tax purposes. So next is the partnership. A partnership is a business organization owned by two or more persons. So the partners contribute money, property, or industry. So ang lahat profits are shared among partners. So there are types of partnership. So the first type of partnership is GPP or the General Professional Partnership. So a General Professional Partnership is formed for the practice of common profession. So basically, dili sila engaged in trade or business. So meaning the partnership itself is not taxed, but the partners are taxed individually on their share. Like for example, mga law firms, mga accounting firms, and last, business partnership. A business partnership is formed for profit and engaged in trade or business. So meaning it is treated as a corporation for tax purposes and is subject to corporate income tax. So taxes play a big role in financial decisions for both individuals and corporations. So for individuals, tax rules can shape investment choices, encourage retirement savings, and even influence the decision to start a business. For corporation, tax rates affect where they operate, how they finance themselves, and how they plan internationally to reduce costs. At a broader level, corporate taxation impacts economic growth, attracts or deters foreign investment, and affects the stability of government revenues. So for overall, taxes are a key factor guiding financial behavior and economic outcomes.
Our next topic is income recognition and timing strategies. Income recognition refers to the point when revenue is officially recorded in the books. This must be aligned with IFRS 15, revenue from contracts with customers, and BIR rules. Timing strategies is crucial for tax planning because BIR requires proper documentation such as official receipts, sales invoice, and progress reports. Misalignments can lead to penalties. In cash flow management aspect, timing strategies helps businesses manage liquidity, especially with quarterly VAT and income tax deadlines. Key timing strategies. First strategy is immediate recognition. Revenue is recognized at the point of sale or service delivery. These must be aligned with PFRS 15 and BIR requirement to record sales once goods are delivered or service rendered. For example, a sari-sari stores records income immediately, and customers buys a snacks. The rest is, if receipts are not properly documented, BIR may impose penalties for under-declaration. Second is deferred recognition. Common and subscription-based services such as gyms and telecoms. PFRS requires matching revenue with the period of service, while BIR allows deferred but insists on clear documentation of contracts and schedules. For example, Globe Telecom recognizes prepaid load revenues over the usage period, not at the time of purchase. The rest is, if documentation is weak, BIR may demand recognition upfront, increasing tax liability. Third is percentage of completion, widely used in construction and software projects. PFRS 15 requires recognition based on progress milestones, while BIR accepts this method but requires progress billing statements and certificates to support recognition. For example, a Cebu-based construction firm building a condominium recognizes revenue as each floor is completed. The rest is inaccurate progress measurement can trigger audit disputes. The last strategy is completed contract method. Revenue is only recognized when the project is finished. This is allowed under BIR rules for contracts with progress that cannot be reliably measured. For example, a contractor building a custom home in the province recognizes revenue only upon turnover. The rest is BIR may scrutinize this method for tax deferral abuse, especially if projects span multiple years. Strategic consideration. First is tax implication. If you record income right away, you will pay more tax now. If you spread it out or deferred, you can manage cash flow better. But the BIR will only allow this if you have proper documentations like contracts or progress reports. Second is investor view. Quick recognition makes your company looks profitable in the short term, while spreading income shows stability and compliance, which investors like for long-term trust. The last consideration is regulatory rules. The BIR requires consistency. Once you choose a method, you must stick to it. If your accounting method doesn't match BIR rules, you could face penalties. Best practices. First, follow IFRS 15 and Philippine Financial Reporting Standards. Second, keep clear documentations like contracts, invoices, and progress reports for BIR compliance. Third, use ERP systems like SAP or Oracle to automate recognition schedules. And lastly, conduct regular audits to avoid disputes with the BIR and ensure transparency.
And now, let's talk about deduction optimization, substantiation strategy, in simple terms. How to legally reduce taxable income and how to properly defend deductions a tax audit or during a tax audit. Remember, tax deductions are not about avoiding tax. They are about paying the correct tax under the law. Let's start with the common itemized deductions allowed from the gross income. 10 common itemized deductions from gross income. These are the 10 common deduction businesses may claim. Number 1, ordinary and necessary business expenses. Second, interest expense. Third, business-related taxes. Fourth, losses. Fifth, bad debts. Sixth, depreciation. Seventh, depletion. Eighth, charitable contributions. Number 9, research and development. And 10th, pension trusts and contributions. But here's the important point. Just because an expense exists does not automatically mean it is deductible. It must pass certain legal tests, and that's what we'll discuss next. How to evaluate if an item is deductible? I call this a quick deductible test. A business expense is deductible only if all of these are present. First, it must be ordinary and necessary, meaning normal in the business and helpful or appropriate. Second, it must be paid or incurred during the taxable year. Third, it must be directly connected to the business. And fourth, very important, it must be properly substantiated. No proof, no deduction. The BIR requires official receipts, invoices, and records showing, for example, the amount and the business purpose. Also remember, accounting record must generally preserve for 10 years. So documentation is not optional. It is mandatory. Common deductible items with proof required. Let's now apply the test to common businesses' expenses. Number 1, salaries and wages. These are deductible if reasonable and supported by payroll, contracts, and time records. Number 2, rent, utilities, office supplies, and repairs. This must be supported by invoices and official receipts. Number 3, professional fees and consulting. Here the service agreements, invoices, and proof of payment. Number 4, transportation of travel. It must be business related. Keep tickets, itinerary, receipts, and proof business purposes. Notice the pattern? Deductibility always depends on documentations. Next, entertainment and interest expenses. Entertainment expenses like businesses meetings can be deductible if they are ordinary and necessary. Second, properly supported by documents. However, if the expense is legal or against public policy, it's not deductible. Now, interest expense. Interest on business loans is deductible, but there is a special rule called interest arbitrage rule. The deduction is reduced by 20% of interest income that is subject to final tax. So it's not always 100% deductible. You must compute carefully. Finally, this is the best audit defense strategy I teach. For every major expense, keep 3 layers of proof. Layer 1, invoice or official receipt. Layer 2, prove it is business related. For example, a contract, memo, itinerary, and delivery receipt. Layer 3, proof of payment and accounting entry, like bank transfer, voucher, or ledger. If meron kang amount plus business purposes plus proof, then your case is strong in an audit. Remember, substantiation wins audits. To summarize, deduction optimization is not about claiming everything. It's about claiming what is legally allowed and properly supported. In taxation, documentation is power. No receipt, no deduction. No proof, no defense.
Common non-deductible items and why. These are classic items the tax code disallowed, so you should classify them as non-deductible or treat differently like capitalization. First, personal living or family expense. These are not related to business operations, so they are automatically non-deductible. Second, the capital expenditures. These include new buildings or major improvements. These are not treated as expenses but as an asset and are recovered through depreciation. Third, restoration expense where depreciation already exists. If depreciation has already covered wear and tear of an asset, the same cost cannot be deducted again. Next is the life insurance premiums, where the taxpayers is the beneficiary. Next is the bribes, kickbacks, and the similar payments. These are the illegal or the unethical payments and are not allowed as deductions. Next is the certain related parties losses. So the losses from the transaction between the related parties may be disallowed to prevent tax manipulation. Then lastly is the income tax and the certain other taxes. So taxes may be deductible except those specifically. Example, the income tax under the title is not deductible as the tax expense deduction. Withholding tax plus deductibility, what changed? Important update. Previously, if a business failed to withhold or remit the required withholding tax, the expense could be automatically disallowed. Under the newer BIR guidance aligned with ease of paying taxes law, starting January 1, 2024, failure to withhold tax no longer automatically disqualifies the expense as depreciation. Compliance still matters, but the penalty is no longer automatically expense disallowed for the covered period.
Good day, everyone. Today I'm going to discuss French benefit tax or FBT, which is an important concept in taxation, especially for employers and organizations that provide non-cash benefit to their employees. First, let's define what FBT is. French benefit tax is a tax paid by employees on certain benefits they give to employees aside from their regular salaries. These benefits are usually non-cash, such as company cars, housing, or paid membership. The main purpose of this tax is to prevent tax avoidance. Without FBT, companies might choose to compensate employees through perks instead of salary, so they could reduce taxable income. FBT ensures that these benefits are still taxed fairly. Now, why is FBT planning important? Proper planning helps companies minimize their tax liabilities while still complying with tax laws. It also allows them to structure employees' benefits strategically and improve employee satisfaction, since workers can receive valuable perks without necessarily increasing the company's tax burdens excessively. There are several types of French benefits. These include motor vehicles benefits, like when a company provides a car for private use, property benefits such as housing or low-interest loans, expense payment benefits like paying for school fees or club membership, entertainment benefits which includes meals, travel or recreational activities, and finally, residual benefits which covers any other non-cash perks that include the previous categories. Let's now look at FBT is calculated. The basic formula is FBT equals the taxable value of fringe benefits multiplied by the FBT rate. There are different methods used to determine the taxable value. For example, the statutory formula method is commonly used for car benefits. The operating cost method is used for motor vehicles, based on the actual expenses. And the gross-up method converts the benefits into its equivalent pre-tax salary value. Let me explain how companies plan FBT strategically. First is salary packaging. This means that employees receive part of their pay as benefits instead of only cash. So instead of giving a higher salary, a company may provide a car or health insurance, which can be more tax effective. Second is a choice of benefits. Companies prepare benefits that are either taxless or exempt from FBT. For example, inana is mag-provide sila og mga work-related laptops or mobile phones. This usually does not attract FBT. Third is the timing of benefits. Companies carefully decide when benefits are provided. For example, spreading benefits across different FBT years instead of providing everything at once help reduce tax pressure. Fourth is using exemption and threshold allowed by tax law. For example, small gifts or occasional meals may fall under the minor benefits exemptions and are not taxed. Lastly, companies can share high-value benefits among multiple employees. For example, instead of one employee using an expensive company car full-time, several employees share it, lowering the tax per person. So that means that the company are not avoiding tax illegally. They're using smart planning within the law. Even with planning, companies must follow legal rules. They must keep proper records para sa tanang benefits nga ilang gi-provide. For example, keeping receipts, invoices, and vehicle usage logs. They must ensure that benefits match the tax law definition. For example, a benefit must actually be work-related to qualify for exemptions. Employers also need to file FBT returns correctly and on time. For example, submitting annual FBT reports to tax authority. Finally, companies must stay updated on the tax laws changes. For example, if an FBT rates or exemption is mausog, so companies must adjust their planning. There are clear benefits to proper FBT planning. First, it reduces the company's tax expenses. For example, choosing exempt benefits instead of taxable cash bonuses. Second is makaprevent si og penalties and legal problems. For example, correct reportings avoids fines during audits. Third, it improves employee satisfaction and retention. For example, companies may value benefits like cars or insurance more than small salary increases. Finally, it gives companies a flexibility in how they reward their employees. For example, isang companies can design benefit packages without increasing cash salaries. However, FBT planning also has challenges. One challenge is complex calculation or komplikado iyang calculation. For example, calculating car benefits requires specific formulas and records. Another challenge is frequent changes in tax laws. For example, exemption may be added or removed every year. There's also a risk of mistakes. For example, missing one benefit in records can lead to underpaid tax. Finally, companies must balance tax savings and employees' preferences. For example, ang employee is must prefer niya ang cash, even if benefits are more tax efficient. In conclusion, FBT planning is an important part of strategic tax management. Companies should regularly review their employee benefits and calculate FBT accurately. They should use salary packaging, exemptions, and proper benefit structuring to reduce tax in a legal way. Most importantly, they must maintain transparent records and musunod sa tax laws. Makatabang ni siya to avoid legal risk and supports long-term financial stability. So in short, FBT planning is about being smart, legal, and organized when giving employees benefits. In other way, FBT planning is makatabang siya sa companies to reward employees in a tax-efficient way while staying legal and organized. Thank you for listening.